Hello and welcome to Gold and Silver Assets. It's Sunday, the 1st of November 2020. Well, we did have a lot of excitement in the last couple of weeks discussing explosive price moves. Let's change tack and look at gold valuation from a different angle. Now that the gold price has hit all-time highs in terms of US dollars, that can make gold seem rather expensive. But there are distortions when using fiat currency to value an asset, making how cheap it is difficult to assess. This is where ratios come in handy. Given that investors have the opportunity to switch between different asset classes, we can use ratios to determine the relative asset valuations. The advantage of doing this is that it removes the dollar or currency component. It also removes the inflation component. We're therefore directly comparing one asset to another. The other useful thing is that there are studies that have shown that some of these ratios are actually mean reverting. What do I mean by that? Here's the long-term chart of the gold to silver ratio, and the mean ratio over this time has been around 55, so that's that line over here. This ratio, we can see, has a tendency to oscillate up and down around that mean value, and most of the time this ratio is spent between around 40 and 70 over here. When the ratio goes beyond this band, then you can see that it doesn't usually stay beyond that for very long. It spends very little time. It often spikes down and up beyond this range. And whenever price does spike up or down, then what tends to happen is that the ratio tends to go in the opposite direction after that. I kind of think of it like an elastic band. When it's been stretched in one direction and then you release it, it pings back and moves in the opposite direction. We saw a great example of this recently here. And so the gold-silver ratio over here hit around 126, and right now it's down to in the 70s region. And so you can see this was actually a historic value. So it was at a very, very extreme level. And that's probably why it came down so quickly. When choosing between asset classes, ratios are just one of the metrics that can be used in making your decision. In this example, when the gold-silver ratio was 126, that meant that silver was significantly cheaper in relation to gold. Having said that, ratios should not be used on their own. It's just one metric to consider. One of the things to remember is that ratios don't give you any significant indication in terms of absolute price moves. If the ratio is dropping, then that doesn't necessarily mean that one or both of the assets are dropping. Both of the assets could actually be rising substantially, but one could be rising more than the other. Alternatively, both assets could be dropping, but one to a lesser extent than the other. And so really it's a relative thing, and that's hugely important to remember when you're looking at these things. I also don't think ratios are very useful when you're looking at short-term moves. The ratio charts that I'm going to cover in this discussion go over decades, and the changes to the ratios can take time to play out. Trading assets using ratios is therefore best suited to the long-term investor who has patience. One of the things you'll note, and I get asked about now and then, is the gold-silver ratio in the market report section, and I don't really discuss it there very much. The only time I did bring it up was during the time when the silver ratio spiked up to over 100. But once it gets into these kind of mean areas, it doesn't really tell you much in terms of the short-term moves. The other thing to remember is that ratios don't account for all of the other costs and advantages that come with investing. So it doesn't include things like trading fees, ongoing expenses, dividends and income, taxes and leverage. The charts don't include any of these, and these are things that do need to be considered when switching assets, and they need to be considered on an individual basis. Before we move on to looking at specific asset ratios, I thought it would be interesting to look at the Consumer Price Index, or CPI, relative to gold. This chart looks at both CPI and gold indexed to 100 in 1971. And we can see that this ratio was highest in 1970. At that time, the rate of inflation was around 5%. In 1975, the rate of inflation had gone up to 11%, but at that time, gold price had gone up by a much greater amount, hence this big drop in the ratio. In 1981, the inflation rate was around 13%, and again, gold had gone up by a lot more than that, and hence the drop in the ratio. The interesting thing about this chart is that currently this ratio is down here, and that's the same level as it was in around 2012 and in 1980. But then again, if you think about it, and we discussed this in my videos about inflation, there are distortions in terms of the official CPI. And so I don't really trust this chart. What I'd really like to do is see this ratio chart using ShadowStats figures. That would be interesting. Another interesting ratio is to look at the money stock to gold ratio. So here we've got the chart of the M2 money stock to gold ratio. And with this, the higher the ratio, the better gold is relative to the amount of currency in circulation. Here the mean is around 10, that's over here. And in the year 2000, we can see that gold was great value. Right now, gold seems to be at fair value relative to the currency in circulation, and certainly couldn't be considered as expensive. Okay, let's talk about specific assets now. Let's start off with stocks. So this is a chart showing the Dow to gold ratio. For this and all the assets that I'm going to discuss from here, I will frame it as the number of ounces of gold required to buy a unit of a particular asset. For example, here in the year 2000, it took just over 40 ounces of gold to buy a share of the Dow. The higher the ratio, then the better value gold is in relation to stocks. From the year 2000 down to 2012 here, we can see that gold outperformed the Dow. That's why the ratio dropped. Now, that's not something that's widely known by the general public. Currently, the ratio is at around 15 here. And that's kind of close to what looks like the mean on this chart. The ratio has been as low as around 1.5, and so that's a tenth of what it is now. But if we look at the same chart but on a longer time scale, we can see something very, very interesting here. The red line in the middle here indicates the date of the formation of the Federal Reserve in 1913. Before that date, you can see that this Dow to gold ratio moved up and down within this upward sloping channel here. The green line shows the mean of that channel, and the green band shows a 75% confidence interval here. Now, I would argue that after 1913, the pattern of oscillation of this ratio changed. Instead of going up and down in this upward sloping channel, instead we've got prices oscillating by a much greater extent within this widening funnel. To me, the mean within this period looks to be more like around 8, I would say, over here. According to this, then, that means that stocks being around here could be considered as being expensive relative to gold. And note here that there is a possibility that this ratio could go as low as 1. That would be a great time to be selling gold and buying stocks. But of course, we don't know if this ratio is actually going to go to that level. It could just go part of the way before turning around. What I'm saying here is that if we do see these extreme levels, that increases the signal for selling your gold and buying stocks with the proceeds. What about residential real estate? The 40-year mean for the real estate to gold ratio is around 282. That means it takes around 282 ounces of gold to buy a house in the USA. In the year 2000, over here, real estate was expensive relative to gold. And for the 12 years after that, gold actually outperformed housing. Again, that's something that the general public don't widely know. And the reason for that is that even though the ratio was dropping, house prices were still going up in a bubble. And the other thing is that leverage is used to buy real estate, which isn't the case for gold. And so the nominal profits are much greater and therefore draw a lot more attention. And none of this is shown in this chart. We're currently over here, which is below the mean. The mean is around 282, that's around over here. And so that means that real estate is actually reasonably priced relative to gold. And that's actually surprised me. This is even more apparent when we look back at this chart, which covers 130 years of the housing to gold ratio. The best times to buy gold were in 1925, 1970 and 2001. And the best times to switch from gold to real estate were 1935, 1980 and 2011. Moving on to oil, so this is a chart of the oil to gold ratio for the past 70 years. The interesting thing we can see here is that oil is the cheapest it has been in 70 years over here. And it's about as close to zero as you can get. Note that it's also well below the mean, which I would estimate to be around 0.07 over here. Because it's so far stretched below that mean, that tells me that if we assume that the mean reversion theory is correct, then oil is a better buy than gold right now. We're used to seeing the gold-silver ratio chart, but to be consistent with all the other assets that I've discussed, this is the silver to gold ratio, i.e. how many ounces of gold it takes to buy an ounce of silver. The mean here is around 0.018, that's around here, and the ratio is currently at 0.012. So according to this, gold is still relatively cheap compared to gold, but not as cheap as it was back in March over here. And finally, we turn to the gold miners. This is a log chart, so remember that if we had it drawn as a linear chart, this would be even more extreme. And this is a chart showing the Barron's Gold Mining Index ratio to gold over the past 70 years. And they've drawn the median at 1.46. And I think the mean would probably be a bit lower, maybe at around 1 over here. Over the past 15 years, we can see that the gold miners were absolutely hammered down over here relative to gold, and it's currently well below that mean ratio over here. So again, it's stretched to an extreme, and that suggests that gold miners are super cheap right now relative to gold. There's a German research paper that actually analysed various gold ratios in quite a bit of detail, and I've put the link in the description for those that are interested. One of the aspects that they looked at was the degree of variation in these ratios, and this is shown by this box plot here. One of the things to note is that because of scaling problems, they actually had to rescale the gold silver and the gold oil ratio by 1/10. So that's what this represents over here. My interpretation of this is that the ratios fluctuate the most are those that will give you the most benefit in terms of switching assets at the extremes of the ratios. This implies that silver and oil are the assets to look at when you're looking at extreme valuations relative to gold. In summary, relative to gold, we can conclude that currently stocks are expensive, houses are actually reasonably priced, oil is very cheap, silver is reasonably cheap, and gold miners are very cheap. In fact, I might put an extra very in there. Bear in mind that all of this is on the longer time scales, and so these things do require patience. It's not something that's going to happen in the next few months. This can take years to play out, but I think all this information that we've looked at here is going to be very useful to us going forwards. On a different note, I know that some of you might be interested in looking more closely at some of these charts, and on YouTube it can be difficult to zoom in and spend time looking at them. So what I've done is, for the first section of all of my shows, I've put them all up on my website so you can get a close look at those charts. There is a little bit of a backlog, so I'm still catching up. I should catch up in the next week or so, and the notes for today's show should be up by the end of Monday. So if you're interested, go and take a look. Next up, the market update. Let's start with gold priced in US dollars on the monthly scale, and of course another month has gone by and another red candle has appeared. Remember when we had all these green candles and there was a lot of excitement, and I had said that once you get past 4 green candles, you've got to start getting worried about getting a red candle. But I also said that I wasn't too worried that we'd get a massive red candle. Just a red monthly candle would do. And in fact, we've had 3. Where do we go from here? Well, if we look at this big picture scale, remember that we've got the top of these wicks over here, and the tops of the bodies of the candles are down over here. And that's the support zone that I'm looking at. And so we're still above that zone there. So I think there is still a little bit more downside, but I think that zone is going to provide pretty strong support, and price will actually bounce off of that. And that, for me, is what I think the bottom will be. Of course, picking the bottom of these things is notoriously difficult. So that's just one opinion. Doesn't mean I know exactly what's going to happen. But of course, I'm thinking of the bullish case for gold, and there's a whole variety of reasons. I'm not basing that assessment of this bounce on any one particular factor. It's just a combination of factors. And those of you who've been listening to these videos for some time now will have put all those factors together and see where I'm coming from. But of course, nobody knows exactly what's going to happen, and we've got to consider what all the other cases are. The first thing to note is that on the monthly scale, we've got this uptrend and we remain in an uptrend. And as long as that's the case, we must assume that price will continue to go up. The only time that we would change our view would be if price dropped below this trend line. And so we're talking about the $1,300 range in terms of US dollars. I think that's very unlikely to happen. And of course, if it does drop below that, we're looking at, triple figure gold. I just can't see a situation where that's going to happen. So I assign that as a very low probability. Of course, nothing is impossible, but for me, that's just a very, very unlikely option. The next possibility is that there's a retest of this support zone along here. Again, I think that's just so far away and it just seems pretty unlikely. It would make the chart look pretty weird as well, and I just can't see what kind of pattern we'll be getting if that were to happen. And then the next possible support area would be this uptrend, which is on the weekly scale. You can see it as well. And so this is a shorter term uptrend. And that would give us a target of around 1,600 US dollars. But if you look at it, to get through to that, you'd have to fight through all of this price action over here. And that's not an easy task. You'd have to have a pretty major event for it to do that. So again, that's not impossible, but it's more possible than those other two scenarios I spoke of. But as I said, for me, the highest probability scenario is some kind of bounce within this support zone up here before the next move up. Now, I'm not saying that this move up is going to go up like a rocket straight away. Sometimes it might take a bit more time before it moves up. It could do something like that. We'll just have to wait and see. But the point is where this turnaround is going to occur. Let's have a closer look at that. So this is gold priced in US dollars on the daily scale. And last week we were talking about these trend lines over here. And I said that I thought we were going to get more down moves to come. And that's what happened. Now, again, I don't think this down move is over yet. The positive thing about this whole price action is it's actually very gentle. Now, it may not have seemed like that, particularly when you got a big candle like that, but this is quite controlled downwards movement, and it's not something to me that looks like, a major top. And so again, that supports this view that we're close to a bottom in price over here somewhere. The question is where exactly that is, and we're getting pretty close to it. As I said last week, I think there's a couple of options. One option is just below the 1840 level over here. But the more likely thing for me is this support zone here that we spoke of in the last chart. Now, there's about $100 difference between there, and you're not going to get the exact bottom of this. So if you are considering buying, don't wait for the exact bottom, because we don't know where that's going to be. It could be over here, or as I said, I could be completely wrong and it just goes straight through there. So next week, I think we're looking for maybe something like this. And whether it's something a little bit more dramatic and we get a bigger candle going through there, I don't know how long all this is going to take either. But remember, next week we've got the election coming up, and that's likely to kick off some volatility in the markets in general. Moving on to silver priced in US dollars on the daily scale. And we've got some interesting price action over here. The first thing to note, we had this long-term uptrend line over here, which has now broken. But the other thing is we had this, which I called a bear flag, which again also has broken. So we had those two areas of support that completely broke there. So now what I'm looking at is this over here, which could be a bull flag, if you think about it. So this could be the flagpole up here. And then we've got this flag formation. And if that's the case, then we're looking at a target just above $20 over here. And then I would expect price to kind of bounce off of that and then head back up to the top of this flag. If it's to the flag, then we could get action like this where it hits the top of the flag. It could get knocked back a little bit before making its move to get back into this zone of resistance above. The other possibility is that price goes up from here, but it just doesn't look like that to me. Anyway, let's see what happens. And next we have the GDX on the daily scale, and the miners are holding up pretty well. Again, we've got this downsloping channel. So where do we go from here? Well, there's a couple of things that I've been thinking of. One possibility is we can go back up to the top of this channel and go off to the races from here. But as I said, with the gold and silver, if we are expecting a little bit more downside, then this channel should, in theory, break. Now, I don't think it's going to break straight away because one of the things we've got a bit of a gap here, and that doesn't look like a runaway gap to me. So I think we're possibly going to move up a little bit to fill that gap before moving down. And again, with this channel, that would represent a partial rise. One way of looking at it, I haven't done this for this, but you could look at the Fibonacci retracement for this move here. But yeah, if it does do that, what are our targets? Now, this is an interesting thing because this red line here is that long-term area which should be strong support. But remember, the miners are quite temperamental in terms of their price action, and they can do some strange things. I would expect that to remain support, but if it doesn't, then we do have a big gap over here that does need to be filled. And that would kind of fit in with where the height of this channel is in terms of price targets, roughly. So look, I don't know if that's going to happen, but we've got to remain open to all possibilities. And so it's just something I'm bearing in mind. And the SILJ, last week we were talking about this channel, which I thought was going to break, and it broke, actually gapped down again, just like the GDX did. And again with this, possibly we'll get that gap filled, and then this could move down further. I'm looking at a target of around, let's say about 11. There seems to be a bit of support over there because of all of this over here. Of course, if gold and silver prices do hold up, then possibly this could represent the bottom here, and then we just keep going up from there. But again, it all depends on what gold and silver are going to do. Thanks for watching. And one of the interesting things that I found about doing these shows is that we've got a wide range of different experiences in terms of our viewership. We've got experiences ranging from beginners to very, very experienced. And interestingly, we've got a few viewers who experienced that first bull market in gold and silver back in the 1970s. I wasn't a participant at the time, but one of the things I found very, very useful is talking to people with such experience, because they're the ones who've made all the mistakes. They've seen all different types of market conditions, and they will have learnt from it, I'm sure. The greatest education comes from learning about the pitfalls and mistakes that occur. And in this channel, there's plenty of mistakes that I make, but of course, myself and you will all learn from those mistakes. So what I'm interested in hearing from is anyone who was participating in that any of the last two bull markets. What are the lessons that you've learned? What are the mistakes that you made? Put it all down in the comment section. Anyway, that's all for this week. We'll see you next week. Bye.